Good afternoon, ladies and gentlemen. My name is Simon Mills. I'm a senior associate at the Zien Group, and I would like to welcome you all to today's FS Club webinar, where we're going to be discussing how to save the world with rigorous carbon accounting. I'm joined by Professor Karthik Ramana, who is Professor of Business and Public Policy at the University of Oxford's Blavatnik School of Government. As always, the agenda for this webinar is very simple. Following my introduction, Professor Ramana will make his presentation, and then we're going to move on to the Q&A session. Now, I'm afraid that you are all muted, but you are able to submit your questions to Karthik throughout using the chat tool to the right of your screen, and you can do this at any point of the presentation. Please do chip in at any point of the proceedings. I'm going to be collating your questions and we'll put them to Karthik at the end. Now, as with all of our FS Club webinars, we're going to be recording this session and you will be able to access these slides and the presentation at a later date. But before we move on, I really must thank FS Club members who have opened up our webinar series to the public. With their help, since March of 2020, we've held over 300 of these events on topics as diverse as money laundering, the metaverse, and high salinity agriculture. Now, the FS Club is the premier global executive knowledge network for technology and finance, where members and their guests can meet over a glass of wine to debate key issues which impact on financial services, technology, and society. It's very much like a 21st century version of the city's 17th century coffee houses. So that's enough from me, and now without further ado, I would like to introduce today's speaker, Professor Ramana. Karthik, please tell us about carbon accounting.
Excellent. Well, thank you so much, Simon, for having me. And I didn't know that there were glasses of wine involved, and here I am sitting behind the Zoom screen. I feel like I wasn't given the gold star package, so I'm going to come claiming my glass of wine at some point. But for the rest of this, our time together, I'll spend a little bit of time talking about how to save the world through carbon accounting, which is the title that I've promised to speak on. And effectively, let me start with a story, which is about a year and a half ago now, I was invited to serve as a discussant at a conference on carbon accounting. And I hadn't done a lot of work in this space. The last time I'd written a piece on ESG accounting was probably 2012. And so, and I'd moved on to do other things. And I was at this point particularly involved in my role at Blavatnik, where I'm the director of the Oxford MPP program. And so, but the organizer of the carbon accounting conference was very, very insistent that I accept the call to be discussant. And so I went kicking and screaming, and I read the underlying paper, and I was astonished that what they were doing, and that they were calling it carbon accounting. Because 20 years ago or 15 years ago, I used to teach the core accounting class at the Harvard Business School MBA program. And on the very first day of the program, we would say to students two things: that any good accounting system basically has two properties. The first is that it counts everything that is material. And the second is that it counts it only once. And over the course of my career, I have never encountered anyone who has push back on these two principles. They seem really self-evident. And yet, as I looked at what it is we're calling carbon accounting, and notably what's called the Scope 3 standard in the GHG protocol, it violates these two very basic premises of accounting. And I said, gosh, this can't be right. So this was the basis of my presentation. I said, look, there's something really wrong. If we're serious about climate change, then this is not accounting. We've got to figure this out. And in the audience was my long-standing mentor and colleague, Bob Kaplan, who is very famous in this space for having invented activity-based costing. And Bob sent me an email afterwards saying, Karthik, I couldn't agree more with you. We need to figure out a way to solve this. So we put our thinking hats on. Bob, of course, is a pioneer in cost accounting, and I've done some work in inventory accounting And we said, well, actually, there are some pretty simple solutions here if you go back to 600 years of bookkeeping practice. And so on the basis of how financial accounting and cost accounting solve problems of measuring complexities in supply chains, together with some advances in climate science and blockchain technology, which I'll explain in a minute, we came up with something called the e-liability approach to rigorous GHG accounting. And so we put it out there. It hasn't even been a year since we put it out there. It was November of 2021, so it's now just coming up on a year. And in fact, one of the first calls we got was from the head of a major securities market regulator in a very large country. I won't say which. And this is someone who sort of knew us because we are sort of part of the same academic circles. And this individual said to us, "Hey, this is a great idea. Who's doing it?" And we said, well, as far as we know, nobody's doing it. We just dreamt it up in our offices. And he said, well, why don't you go and get some companies to embrace this and do some pilot studies, and then come back to us in a bit of time when you've got some data, and let's see if we can do something together in this space. So we have spent the last few months, we have about 5 or 6 companies now running pilots of the e-liability approach. I'll talk briefly about that. In a couple of weeks, I'm going to be at the G20 in Indonesia, where we'll be launching what's called the E-Liability Institute. This has been funded by a bunch of Silicon Valley entrepreneurs who are deeply interested and concerned about climate change. And it's a not-for-profit institute that is focused on getting companies to embrace this method, as well as buying out the data from I mean, we're not paying for them, but building out the data confidentially from them, and then of course supplying that data to regulators so that they can build effective accounting standards in this space. So that's my goal here. And if I have one objective of this talk, it is to get you intrigued enough in e-liability accounting so that you will go back to your organization and say, we've got to do a pilot. And then at the last screen of this slideshow will be my email address, and you should send me an email and say, hey, Karthik, we'd like to do a pilot. So I'm telling you the punchline right up front. That's why I'm here. So now can we move on to the next slide? Excellent. So, the US Congress just passed a bill, the Inflation Reduction Act, which puts out, I think, about $400 billion in subsidies for things like, building wind turbines so that we can get more sort of wind energy and so forth, which might well be a great idea. But if you think about it, to date, we still don't know what is the total emissions impact of a kilowatt hour of energy from a wind turbine versus the total emissions impact of a kilowatt hour of energy from, say, a natural gas plant or a coal-fired plant or whatever it might be. We don't know because we don't do the equivalent of full costing when it comes to GHG emissions. So we know the total monetary cost, but we just don't know what the total emissions profile is. And so effectively, if we are serious about climate change and we're going to put $400 billion in subsidies to build wind turbines, we should know at the very least whether they are in a full costing perspective, less emissions intensive than, say, existing hydroelectric plants or nuclear or coal-fired or whatever it is we've got. Because otherwise, we're just making really poor policy choices. I mean, this happens also when we think about something like Tesla, world's most valuable car company. And we still don't know what is the total emissions profile of buying something like an electric car, given its depreciation cycle, versus, driving a Ford F-150. We're assuming that it is lower, but we don't know. And so the whole point of something like e-liability is to be able to do full costing from an emissions perspective. Can we go to the next slide, please? Okay, and this is just some data from Rocky Mountain Institute showing how important this is, because with the exception of fossil fuel companies, where of course the ratio of supply chain emissions to direct emissions is below 1, for pretty much every other sector in the economy, that ratio is greater than 1. And then when you look at companies in sort of, they're retail facing like Google and Microsoft, et cetera, that ratio is actually very, very high. And I think it was today's FT that has a piece about how once you start doing this proper supply chain accounting, you find that companies in the tech sector are actually quite dirty, much dirtier than, because right now there's all this sort of, we will cancel fossil fuel companies from endowments and this and that, which might well I mean, I have no horse in this race. It might well be a good policy decision, but I just don't know whether, in fact, it turns out that big tech companies are dirtier than fossil fuel companies once you start doing the proper accounting. So our goal here, we have no agenda other than to do full cost accounting in order to understand what are the true emissions impact of any product or service in the economy. Can we go to the next slide, please? Okay, so in order to understand this, we'll just do a little bit of a brief primer on GHG accounting as it currently stands. This might be self-evident to everybody in the room, but if it's not, I'll just sort of put it out there. So effectively, the dominant standard for GHG accounting in the world is something called the GHG protocol, and it's produced by this group called, well, it's a combination of the WRI and the WBCSD. But in any event, and what the GHG protocol does is it basically divides an organization's emissions into 3 buckets: Scope 1, Scope 2, and Scope 3. Scope 1 is basically direct emissions from activities that are owned and controlled by the company. So let's say I own a fleet of corporate vehicles in my company, then the emissions from those vehicles would be my Scope 1 emissions. Scope 3 emissions are basically indirect emissions, both emissions indirect upstream, that is to say supply chain emissions, as well as indirect downstream, that is to say emissions in my customer and my customer's customers and so forth. And you say, wait a minute, you skipped over a number. You went from Scope 1 to Scope 3. What's Scope 2? Well, Scope 2, it turns out, is just a special class of Scope 3 emissions where we kind of are able to measure them quite accurately, which is the emissions from upstream supply chain that are attributed to electricity and heat. So, like heat energy and electric energy that you purchase off your grid, that's Scope 2. And the only reason, in fact, Scope 2 was carved out from Scope 3 is because at the time of writing this standard, we kind of knew how to measure Scope 2. We had no idea how to measure Scope 3. And so we said, okay, well, Scope 3 is everything else. Now, of course, if we're serious about climate change, as the previous graph showed, you really have to figure out Scope 3. So Scope 3 is where the action is, and that's where, right? The problem, of course, with Scope 3 is, as it's defined, it's effectively an unmeasurable concept. And that's why we created Scope 2. So when they created Scope 3, it had more of a rhetorical purpose than an accounting purpose. The goal was to create a measure that would sort of say, we've got to be thinking about this without sort of thinking about how actually we would measure it. And that's the problem. So in fact, if we can go to the next slide, there are 2 well-documented weaknesses with Scope 3. Actually, there are 3. Let me talk about all 3. The first, actually, I've already attributed, which is that Scope 3 intermingles what happened upstream or in the supply chain with downstream, which is with your customers and customers' customers. And just think of it for a moment. Everything that happens upstream from the perspective of the entity is basically delivered performance or historical performance. Everything that happens downstream is, from the perspective of the entity, prospective or future performance. So upstream is accounting, downstream is marketing. And what Scope 3 does is basically add the accounting and the marketing together as one fungible unit. So that itself is a problem. So what we're going to do with e-liability is really focus on the upstream and say that's where the accounting comes in. There is obviously a role for downstream, but that's always going to be speculative. It's always going to be prospective from the perspective of any entity. Okay, so that's one issue. The second issue with Scope 3 is it measures emissions at the level of entities. So now you think about it, any modern company like say Apple that make these iPhones has hundreds if not thousands of suppliers, and those suppliers will have hundreds if not thousands of suppliers and so forth. So effectively, if you're trying to calculate what are the emissions in your supply chain, you're looking at very quickly what we call a problem of geometric complexity. It just gets exponentially harder. And so you'll never know who your suppliers are, let alone what their emissions are. So how does the standard solve this? It says, well, actually, if you don't know that, don't bother getting supplier-specific data. just use industry average data. Now think about that for a moment. That would be like the IASB or the FASB saying to companies, if you don't know what your profits are, no problem, just report industry average profits. That's fine, right? I mean, whoa, like what would you do with that number? It's kind of useless. And that's the problem with scope 3, that the number is effectively unmeasurable and therefore inaccurate. And it takes away any incentive for a company to compete on their emissions reduction excellence. Because the moment you put any kind of investment into this, not only do you use it, all your competitors use it, and all your competitors' customers use it. So what the hell? Now I suddenly have got no incentive to innovate on if you measure things like on industry average basis. So that's at the inaccuracy point. The second issue with, or the third issue with scope 3 is multiple counting, which is to say that because we're measuring these things at the level of entities, when you've got, say, a supply chain with 10 layers in it, then every emission in, or every offset in that supply chain will be counted as many times as there are entities in the supply chain. So, you know, if this really matters for offsets, let's say that there's one company in a supply chain of 10 that has engaged in an offset of, say, 9 tons of CO2. So 9 tons of CO2 have been captured and permanently sequestered in an undersea disused well or something like that. Okay, well, if there are 10 companies in that chain, then each one is going to count the same thing as part of their scope 3 profile, if at all. And that means that the economy will report 90 tons of offset, when in fact only 9 tons were offset. So now when you look at that, this is part of like why people are getting really mad with all of this GHG reporting that's going on, because it's just so much bogus stuff in there. I mean, companies are claiming these things, but then when you start looking at it, there's this multiple counting up the wazoo. So we've got to figure out a way to, right? So these are the two big issues we've got to sort of address with scope 3. Can we go to the next slide, please? Okay, so how do we actually, we can skip all this. This is a little self-gratifying slide, but so we came up with a solution is what that slide says. And that was in November 2021. And in, I think it was April or no, March of 2022, so earlier this year, that we won the McKinsey HBR Prize for it, et cetera, which is good because it brought a lot of attention to it from Fortune 500 companies, and now we can start driving. Okay, so what's the solution? Let's talk about that. That's more important. The basic idea is to measure emissions at the level of products and services rather than at the level of entities. And that's because it's products and services that move through the economy rather than entities. So if you're serious about supply chain emission, you want to focus on emissions at the level of products and entities, products and services. So what this is, for those of you who have an accounting background, these are T accounts. These should be very familiar from Accounting 101. But what this is basically saying is that as inventories move through a supply chain, you've got a corresponding journal entry to that where you effectively will credit the inventory on the supplier's books, debit it on the customer's books, and so forth. There will be corresponding offsetting entries associated with the environmental profile of those inventories. That environmental profile is called an E liability, or we're calling it an E liability. E stands for environmental liability. And unlike, you know, inventories which will be measured in, say, dollars or pounds or euro, this will be measured in things like kilograms of CO2 equivalent or tons of CO2 equivalent. And so you're creating, in parallel to your financial accounting books, a set of environmental accounting books or e-accounting books that effectively track through the basic principles of inventory accounting, the movement of emissions through supply chains. Now, of course, in order to do this, we will need to, can we go to the next slide, please? We will need to have some version of cost accounting operating at the level of emissions. And this is where, so this is basically a stylized example showing how for a sample company which has, say, 2 raw materials and 2 outputs and a certain amount of production process with 2 gases, CO2 and CH4, you can use some sort of basic cost accounting principle to get effectively the allocation of joint emissions or site level emissions to individual products. So this is like cost accounting, but in the context of emissions, right? So can we go to the next slide, please? And once you start doing this at the level of individual products and services, then just like in financial accounting, these will aggregate up to the level of the entity at any stage in the supply chain. So every entity will have effectively a version of e-accounting books or environmental accounting books, which reports. Now, this might look familiar like an inventory statement from a balance sheet. It's got an opening balance, a closing balance. But unlike inventories, which are measured in dollars, this will be measured in tons of CO2 equivalent. You've got opening e-liabilities, closing e-liabilities. The e-liabilities you acquired from your suppliers, so let's say electricity, sheet steel, glass, fabric, whatever it is. Add in e-liabilities from your direct operations, the so-called Scope 1 emissions. Subtract any e-liabilities that you've engaged in through offsets. The only offsets that matter are removal offsets. And then finally, subtract those e-liabilities that you transfer on to customers. So the way this system works is kind of like VAT, a value-added tax system, right? Except it's not value-added, it's value subtracted. Because each time you've got a Scope 1 emission, it's effectively a transaction with nature, where you're creating this liability vis-a-vis nature. And as that liability moves through a supply chain, you've got the equivalent of a value-added system, but a value-subtracted system for these environmental liabilities. So if you understand how VATs work, then you understand how e-liabilities work. It's such a painfully simple solution once you sort of lay it out, right? That's part of, I think, the beauty of it. If we can go to the next slide, please. So let me actually just give you, before I go into this slide, let me give you a little example of how this might work. And I'll take this iPhone again. So this iPhone has thousands of components to it, right? And these thousands of components are coming across, say, 10, 12 layers of supply chain. Now, Apple knows down to the nanocent what is the cost of this iPhone across these thousands of components and so many layers, et cetera. Why? Because it's using basically the principles of inventory accounting and cost accounting. We're saying that Apple can go down to the nanogram, what is the emissions profile of this iPhone. Now let's assume that part of the iPhone components in this iPhone is something like metallurgical coal, because that metallurgical coal will make it into steel, which will make it into sheet steel, which will eventually make it into the circuit board that will make it into this iPhone. But that sheet steel will also be in this flask, et cetera, right? So let's go all the way back to the source of the metallurgical coal, let's say a mine in Australia where you're mining a ton of metallurgical coal. Now, let's say mining a ton of metallurgical coal is associated with 1 ton of CO2 emitted. Okay, so what we're going to do is at that Scope 1 stage, right? Because the only emissions that matter anywhere in the world are what are called Scope 1 or direct emissions. So at that Scope 1 stage, we're going to take that 1 ton of CO2 emitted, and we're going to capture it into a blockchain, into say something like 1 billion tokens. Why 1 billion tokens? Because as that 1 ton of metallurgical coal makes it to hundreds of different users through a supply chain, maybe 7 of those 1 billion will make it into this particular iPhone, and 13 of those 1 billion tokens will make it into this flask, and maybe 6 of those 1 billion tokens will make it into these sunglasses, etc. But this iPhone, of course, has many other components. So as I simply add those up across all of the tokens that made it in here, then I'll say, okay, this iPhone costs $1,000 and it has 793 tokens in it. So that gives me the total e-liability profile of this. And this flask has 240 tokens in it, or whatever it might be, right? So basically the tokens serve as an equivalent of currency. They're effectively a functional equivalent of currency, but they're measuring, say, a gram of CO2 emitted into the atmosphere, right? So all that matters now at this stage is effectively accurately capturing in a blockchain the Scope 1 emissions at the site of the actual emission being incurred. Once you do that, the measurement and the transition of the emissions through a supply chain can be solved through the accounting processes I just described, the inventory and the cost accounting processes. And what's really powerful about this system is that it allows you to audit that number. Let's say Apple's saying this number for this iPhone is 760 tokens. We can audit that in the same sense that we can audit a financial accounting statement, which is what's called a true and fair standard. So currently, to the extent that you have an ESG report that is audited, most of them are, by the way, not audited, but if they are audited, they're audited to what's called a limited scope sense. And what that means is that if a company says our emissions profile is 100 tons of CO2, then at best what the auditor can tell you is that that number, 100 tons, is not obviously false. It's not made up. However, what they cannot tell you is whether that number, 100 tons of CO2 emitted, is anywhere close to the true reality, right? That's what a true and fair audit tells you. If a company says our profit for the year is $100 million, then a true and fair audit says that within a non-material margin of error, the true economic profit is $100 million. What this e-liability system allows you to do now is suddenly to write those kind of true and fair audits on any product and service in the economy and on any entity in the economy. By the way, it doesn't have to be a for-profit company. Oxford University can have an e-liability statement. The Department of Defense can have an e-liability statement, or the Ministry of Defense in this country can have an e-li, right? So any government, not the NHS, can have an e-liability statement. So any entity effectively can, for any product or service, whether it's say a single search on a Google search engine, that can have an e-liability, or whether it's a complicated thing like building a wind turbine, that can have an e-liability. So any product or service, any entity of any form can do e-liability with true and fair audits. Now, the reason why that true and fair audit matters is it's not just about the reporting bit. In fact, the reporting bit is second order. It's because it can be used to drive strategy, right? Apple knows down to the nanocent the cost of this iPhone, not for the fun of it, but because it wants to know, it wants to be able to drive the cost quality trade-off. And it can write supply chain contracts 8, 10 layers deep into its supply chain as a result. In the same way, if you've got this kind of real-time true and fair audited emissions data, Apple can control the emissions profile. It can say, okay, that mine in Australia that is 7 layers deep from me, this is the amount of CO2, maximum amount of CO2 we will tolerate if we're going to be buying any of its products. Suddenly, those supply chain contracts start driving strategy. That's what we're doing with the pilots now, with all of the companies that are embracing this. So that just gives you sort of a quick idea of where we are. Okay, so can we skip to slide 12 now? So just 2 slides past, just in the interest of time, because I want to open this up to questions. Okay, so as I said earlier, we are starting this thing called the e-liability Institute, which will effectively help companies drive this into practice. My goal here is to get as many of you who are on the call to, in fact, become e-liability pilots. We need auditors and ERP providers to develop software products. We know IBM, SAP, several other audit firms, et cetera, are interested already in building products in this. This is great. Let them go ahead and do it. And then, of course, we need regulators like the SEC, the ISSB, et cetera, to jointly embrace this as well. So, and then if we go maybe to the next slide, this will tell you a little bit about you know, what kind of companies make good pilots. Basically those with significant upstream and direct emissions products, which is more or less everyone. Those with a potential competitive advantage, because if you've got a competitive advantage in your emissions reduction profile, then you're really being screwed by the Scope 3 standard, because any effort that you make is being claimed by your competitors. So these companies, if you're an emissions efficient company, then you want to be doing e-liability. And of course, if you've got investors and customers that are really sensitive, you want to build a competitive differentiation profile around you. So one of our pilots is one of the world's largest cement companies. You think about it, cement is like, you know, the most commodity type product you can, has been around for 200 years. And still this company, because of something like e-liability and driving strategy through accurate real-time batch level measurement of emissions profile, has suddenly taken what is effectively a commodity and made it into something that can be competitively differentiated and priced separately, right? Now imagine what kind of innovative potential you can unleash with this. Okay. So why don't we then go with the very last slide, and that will just give you a sense of how to reach me. We're going to do some other stuff now on downstream, as I mentioned, as well as some stuff on GHG offsets. I won't talk much about that, but I want to just open it up to any questions you've got and see where we are with that.
My goodness, that was an absolutely fascinating canter through a really, really important topic. Now I can see from our audience that we have got a lot of questions, but as chairman, the privilege of asking the first one falls to me. Unlike financial reporting, there's not really much in the way of punishment if companies get emissions reporting wrong. What can be done to actually change this?
Yeah. So again, I think two things. One, where we are focused on right now is companies that are using this system to drive sort of value creation opportunities. So our pilots are one of our first pilots is one of the world's largest tire manufacturing companies. And for them, this is all about strategy, right? So this is about using a system like this to figure out where they can save on emissions and therefore make their tires competitively differentiated and therefore more attractive to, say, clients like luxury car makers for whose customers will pay a premium for low emissions tires. So at this stage, we're not even thinking about that. We're just saying, okay, look, there's all this money on the table that companies are not using by being able to sort of, understand where the sources of emissions reduction in their value chain. I mean, look, if companies start, using the system quite sort of extensively, then it won't be half a second before the SEC and other players like that get involved. Already, they're taking an eye on this, and the SEC, in an unusual departure from its practice, has said to companies, if you're going to use Scope 3, we'll give you a litigation holiday. And part of the reason for that is because they know that Scope 3 is bogus. And so they're saying, look, we think we need to do something in supply chain. We just know that Scope 3 doesn't work. And so, we're giving you this holiday while we figure it out. Once something like this starts catching on, my sense is that the regulators will get in on it. There's also, I mean, even basic anti-fraud provisions will cover you from, if you're sort of displaying the audited emissions profile of this phone and it's materially misstated, then, I mean, that's just common law fraud. So, I mean, there's enough protections in the law right now that I won't suggest that the regulation should get ahead of the innovation. I think right now there's so much innovation to unleash in this. Let's let that happen, and then the regulators won't be too far behind.
That's a very good point. Here's a really interesting one for you. How's this going to work with financial services? How would you do e-accounting, say, for a bank? Because obviously the major impact of a bank isn't, lighting the office. It's actually where they're lending their money. So how do financial services fit into this picture?
Yeah. So I think there are two ways to think about this from the sort of financial services industry. One is to think about it like any commercial entity and to say, okay, what is the liability profile of every one of its standard products, and say, okay, so it's got products like loans, it's got products like checking accounts, etc. And say each one of these is a revenue line, and anything that's involved basically as part of its commercial activity, anything that effectively counts as a product or service will have an e-liability to it. And in that sense, the technology is very similar to what we've described. It's it's just the same accounting works for whether you're a coal company, whether you're a cement company, whether you're a bank, whether you're Google, doesn't matter. But of course, financial services companies sit on the other side of the balance sheet of the economy as well. And if you look at something like TCFD, which is this global standard to sort of, hold the financial sector more responsible to sort of, the emissions impact of their portfolios, then, places effectively TCFD needs to count something. Right now, the problem with TCFD is that it outsources the counting to Scope 3. Scope 3 has multiple counting up the wazoo. So banks basically look at this and say, whoa, we're not going to do Scope 3 of our portfolios, because then we'll be counting the emissions 100 times because we hold so many parts of the portfolio. And of course, the way TCFD solves this is to say, well, then Scope 3 is optional. So of course the banks say, oh, then we won't do any Scope 3 at all, right? So this is a lose-lose proposition. It's a lose for the banks, it's a lose for the planet, it's a lose for TCFD and the regulators, so it's just lazy thinking. So if I were the TCFD, I would say, look, we want banks to rigorously and accurately measure the total portfolio impact. But then we have to go back to those two basic principles on the first day of accounting class, right? Count everything that's material, but count it only once. And quite frankly, the e-liability system is the only known method anywhere in the world to do this. It's not because what we're saying is particularly sort of, groundbreaking or innovative. It's the way financial accounting has worked for 600 years. We've simply taken that and have applied it in the environmental setting. So if we're serious about, green finance as a way to sort of cure the world, I mean, if I were someone like Mark Carney, this would be the #1 thing I'd be focused on, because without this, nothing is possible. In green finance is just basically nonsense if you don't have something like e-liability. This is like machine language code that sits on the basis, the foundation of anything that happens in the financial sector in the context of green.
Absolutely. And, at the end of the day, if banks can just say, if you want to borrow money from us, let's see your carbon accounts.
Yeah. And that will of course depend on, their own sort of strategy and so forth. Again, we don't take a view on that, and that's right. So I want to clarify two things here. Firstly, we have deliberately, I mean, obviously I care about climate change, that's why I'm doing this. But we've deliberately not taken a perspective like, oil companies are bad or banks are bad. I mean, quite frankly, we're looking at this as objective accountants. We simply want to measure this, and we want to tell you what it is we find. The second thing to say is that we are not standard setters. We don't want to replace the GHG protocol. We don't want to, I mean, I'm a professor and I love my day job, and I don't intend to sort of, what I'm hoping is that the regulatory agencies and companies will take this and run with it. In fact, this institute we created deliberately with a three-year lifespan, because we said in 3 years we can get 100 Fortune 500 companies to embrace this. Then that's it. That's all we need. That itself, the momentum will feed itself. So our objective here is to get the industry and the regulators to a tipping point where they sort of take this over, and because e-liability is not so much an accounting standard as it is basically foundational accounting principles.
It's like double entry bookkeeping for exactly. The planet. Yeah, absolutely.
And if we're serious about climate change, that's what we've got to do.
And have you been talking to people like Plan A and Carbon Disclosure Project? Because they've been pushing forward in this area, but they haven't got the tools, and this actually looks like the perfect tool that can help them deliver.
We're willing to talk to anyone and everyone that is right. So we did speak to CDP, quite frankly. They said, oh, this is wonderful, but we're simply a data aggregator. We don't take a view on this. And quite frankly, I mean, that to me, that's astonishing, because they should be taking a view on the standards under which the data are, or the principles under which the data are reported. Now, part of the challenge, of course, is that CDP can't challenge GHG protocol. Right, and there's a little bit of politics involved in all this, and the GHG protocol is effectively the default standard setter. So we've got to get the GHG protocol to switch now they've got their own sort of things to figure out, and they are, I think, starting to feel the heat from Scope 3. Look, Scope 3 was completely well-intentioned and well-meaning. When these guys put out the standard years ago, they were so far ahead of their time, and very few people were thinking about it, etc. But it was also the case that there wasn't a lot of accounting horsepower that had been deployed to solve the problem. It was deployed as a rhetorical device rather than a performance measurement device. And now I think the climate crisis has gotten serious enough that we need to start thinking about this from the perspective of serious experts rather than rhetorical feel-good devices. And so that's where the transformation comes in. Of course, part of the challenge is, it's human nature to resist when you've been doing something for a long time, to say, oh, we've been wrong and we need to change. So, but I mean, nothing would make my life easier than if the Scope 3, the GHG protocol took these principles and said, by the way, here's a version 2.0 of Scope 3 that embeds these. And in fact, we've just sent them, we sent them several months ago, a set of 3 simple fixes to Scope 3 that would make it e-liability compliant. I hope they will embrace it. I mean, obviously they have their own due process and so forth, but that would be one measure of success for us.
Now, this is a bit of a technical question, and it's about the use of blockchain. So you mentioned blockchain during your presentation. Do you think this is the only way to do this? And if so, how implementable is it? What would the platform look like? And you know, for God's sake, don't use Bitcoin. Go for something which is
Yeah.
a little lower carbon.
Yeah, no. I mean, you don't need, so this is different, obviously, from any kind of currency or like Bitcoin. But the principle of blockchain actually, look, if you think about blockchain as a technology, and given that it's out there, this is one of the few socially productive uses to which it can be actually deployed, because it I mean, I know that sounds glib, but I'm serious, because what this effectively, if yes, of course, you can do this without blockchain, but it would make the audit costs of something like this vastly higher. Whereas if you want to keep the audit costs low, then capturing every source of scope 1 emission at site into a blockchain and atomizing it into tokens, which then move. So basically, then if I'm auditing the e-liability of this phone or this flask, then all I need to do is count the tokens, which, by the way, I can do mechanically. And once the emissions have been locked in a blockchain at source, you can never game the tokens, right?
So if Karthik, if Michael was here, he'd be chewing the furniture at the moment, because he dislikes the term blockchain, and he thinks that it should be called distributed ledger technology.
And that's fine.
Yeah.
I have no horse in that race. If you want to call, we can call it, we can call it, what did we call it? Elephants and porcupines, or whatever it is. It doesn't matter to me what, but it's that underlying technology that can be put to a socially productive use here, because that then allows us effectively to lower audit costs. That's what I'm after. I mean, I have no fight to fight with the name, or with what happens in Bitcoin or anything like that.
Right, I've got one final question for you, which is around offsetting. Now, this is quite a fraught area in terms of looking at something such as using trees to offset. How would you include that in your e-liability spreadsheet?
Yes, yeah. So look, offsets are a hugely complex issue. Let me just lay out a couple of principles here. Number one is that the only kind of offsets that matter are what are called removal offsets. Okay, so just like the only emissions that matter are scope 1 emissions, because they're the ones that actually enter the atmosphere, the only offsets that matter are emissions that remove CO2 or greenhouse gases from it. So that's what matters. And by remove, you mean that it actually effectively permanently removes. So realistically, there are very few permanent offsets, right? I mean, capturing carbon and sequestering it, say in in disused oil well, is one sort of instantiation of a permanent removal. Something like offsets that are secured, removal offsets that are secured through growths of forests, are at best maybe 20-30-year cycle. And then, so that would be kind of like, effectively having a zero coupon bond for 30 years, and then effectively the liability comes due. So we know how to solve that problem in an accounting sense. And so part of what my co-author Bob and I, together with a third co-author from Stanford on that project, are writing out is a set of basic principles for offset accounting that would be compliant with these e-liability principles. And that would include something like, effectively using the zero coupon liability technology as a way to address the impermanence of things like forest offsets and so forth.
Fantastic. Now, I'm afraid that time has caught up with us, ladies and gentlemen. I know that some of you still got questions to ask. Please do contact Professor Ramana to continue this discussion. You can either use the email he's given you, or you can email us and we'll pass your questions on. It really just remains for me to thank today's speaker, and of course the members of the FS Club for making today possible. I'd also urge you to keep an eye on forthcoming events which are on our web pages for more webinars. These include your next lawsuit coming from a river or forest near you, the EU AI Act State of Play, stablecoins, crypto's killer app or killer of crypto's investors, and Chile issues the world's first sustainability-linked policy performance bond. You can catch up with all of our previous webinars on YouTube or our new Pizzazz TV channel. We hope to see you all again soon. Thank you very much for attending, and goodbye.